Then the next thing is to scope it. So when we scope the issue, we now need to know which standards do we have. So the books that you're gonna get, when you open it, you'll then see a list of standards. It starts off with what? IFRS. That's the top part. Then it has IAS. And it then has what? It then has IFRIC interpretations and SIC interpretations, and that is what we have, and the framework. So now, what is the difference between all this? Why are they all there? Why are they not all sitting under one heading? What do we mean when we say this an IAS and IFRS? So this simply refers to who prepared it. And also it gives you an indication of its relevant, not relevance, but it's let's call it recent updates. So one, I've explained what the framework is all about. It has the key definition and it provides the framework for what? For preparing financial statements. Check. Now, what is an IAS? An IAS, it is an accounting standard developed by the International Accounting Standard Board, the IASB. That's what they are called. So IASB, the International Accounting Standard Board, developed IAS. These are what we call a little bit of the old standards. They've been around for some time. Then there is IFRS. The IFRS, that is the new set of standards. So what they have been on a journey to doing is to simplify accounting and make it more relevant to the modern times. Because the previous standards, it's like they were very generic in nature, trying to cater for different issues. And that left a little bit of too much interpretation in them. Because they were trying to just be as broad as possible in order to provide principles. But IFRS tries to narrow it down and therefore focuses on specific transactions. Like for instance, there is IFRS 15. IFRS 15, it's called revenue from contracts with customers. That is very specific. It's not dealing with anything. So if you have revenue but you don't have a contract, this standard might say it might not need to be in here. Because here we are dealing with revenue from contracts with customers. The previous standard was simply called revenue. And what did it deal with? It dealt with revenue by asset managers, revenue by the owners of assets, revenue like owners of an asset. If I've got cash and I invested in a bank, that interest was revenue. If I've got cash and I buy a share and I get dividend, that was revenue, and so on and so on. But now it's let's clean it up. We don't want revenue to be too generic. We want revenue from contracts with customers. So do you see the thinking about IFRS? It is meant to simplify life, and therefore the IFRSs read better and are much more comprehensive because they are dealing with specific issues. Whereas the ISAs tend to be broad and try to incorporate different industries, different types of transactions related to a particular item. Then we've got the IFRIC, or let's start with the SIC. The SIC is the Standing Interpretations Committee. And what it does, when there was something on the IAS, and I'm trying to apply it, and I'm finding that no, this thing is confusing. You can write to the interpretation committee and say, guys, this is my issue. The way I'm interpreting the standard, I should be treating it this way. What do you guys think? So that's their name. So their name is Standing Interpretations Committee. So they receive all these requests for interpretations and they sit with them. And if they find that the issue is pervasive and people are suggesting or interpreting things in a way that might result in misaligned accounting, that I will recognize an asset, you will recognize an expense, someone will recognize equity. So they then sit and say, this issue can potentially be misinterpreted. And they then write what they call an SIC interpretation. So SIC interpretation will therefore not be a standard. It will just be an interpretation of a standard. Then IFRIC does the same thing, but they are standing committee for what? For the IFRS standards. So they interpret the IFRS standards and write an interpretation note. They don't always do that. Sometimes they say, no, this issue we have clarified in the standard. It's not necessary for you to do it, to seek guidance from us. And oh no, we were mindful of this, but we are realizing that even if there are inconsistency, the inconsistencies are not material. You guys will all reach the same place, or the issue will resolve itself in a relatively short period of time. So that is how then we think about the standards. IAS, some of the older standards. IFRS, some of the newer standards. SIC, there is what? The interpretation committee. And IFRIC, it is the interpretation committee for the IFRSs. So we have this. Okay, then now let's look at what the standards themselves. So we have all these standards. So now the question is, how does one think about them? One thinks about them in what they are supposed to do. In other words, what are they supposed to do? Because it helps you that the moment you see a transaction and it deals with an asset, you can know that I'm here. Or it arises because there's a contract, you can know that I am here. So that is then the beauty of understanding the structure of the standards. So just to clarify and unpack that a little bit more. So we've got what? We've got the framework, which we've already spoken about. Then we've got what I call presentation standards. So presentation standards are exactly that. They don't prescribe the accounting. They only tell you how to present something. But now you might be wondering, what do you mean present? So the financial transaction of any organization, they are presented at the end of the day in what? They are presented in the annual financial statements, which comprises the statement of P&L, the statement of OCI, the statement of financial position, the statement of cash flows, the statement of changes in equity. That's where they go. So IS1 then gives us what? A guideline of where to take things. How should we present them to our user? So that is what it's telling us. It's not telling us any disclosure requirements. It's telling us how we should present it. So another way to think about presentation, is to ask yourself, where can I find this in the financial statements? Like for instance, if I say now, we recognized a revenue of 100 million this year, and you ask me, where do I see that 100 million revenue? Where is it? So I'll then tell you, go to the P&L, that's where it's presented. And if you say that we've got several vehicles that we own, then if I ask, where is this? That is presented in the statement of financial position. So the answers that I'm giving now, it's not that I have seen it so many times, it's because there is another standard that told us where to put these things. And then we are also mindful that this standard will tell us whether something is non-current or a current asset, non-current or a current liability. So this standard will tell us this. It will give us a basis to present financial statements. That's IS1. And it is the one that tells us that there are actually 4 statements that I've mentioned. But its counter friend or its buddy, it's what? IS7, which is the cash flow statement question, a standard. So that is what the presentation standards do. They help us to know where to present stuff. Then disclosure. The disclosure standards, what do? They now help us to disclose transactions. But wait. What is presentation and what is disclosure? Presentation is where it sits on the annual financial statement, or which financial statements it sits on. So am I going to find it in P&L and so on? Disclosure then expands on the things that have been presented. So everything presented, a disclosure might be required to explain it. So I see that you said 100 million is your revenue for this year. All right, yes, that's true. Can you show me something about this 100 million so that I understand it better? All right, go to my disclosure. What will I find? You'll find where I make the 100 million. I will tell you there, what do I do to get to this 100 million? I'll also tell you what assumptions I make when I have got a little bit of an uncertainty about what number to put. So that is what a disclosure standard do. So IFRS 7 will then tell us what we need to do about the different financial instruments. Then IFRS 12 will then look at it and it will then say what? IFRS 12 will then say disclosure of interest in other entities. So as you can imagine, these are focused on disclosure. Then we've got IS 10 and IS 24. IS 24 is called related party disclosure. So whenever they're related party, we need to disclose. IS 10 is events after the reporting date. So that is the disclosure standards. Then asset standard, as you can see, are the biggest set of them all. So that's why we're going to be starting our journey here. So we've got IFRS 5, IS 2, 16, 23, 36, 38, and 40. So like for instance, let's talk about some assets. So if I say I own a vehicle, where does it go? Or which standard will we then use? We are talking about owning a vehicle. We are talking about owning a vehicle. So if we talk about owning a vehicle, there will be a standard that talks about assets that are used by a business for administration purposes. All right, I own a flat of building. That will be an asset that is used for rental purposes. That's an investment property. All right, I own a trademark. Oh, that's an asset that has no tangible form. That's an intangible asset. Oh, this asset no longer works as well as it used to. Oh, there is a standard called impairment of assets. So the asset standards deals with the assets that an organization have. Oh, but I bought this asset in order to resell it. Oh, that is what? That is an inventory. That will be what? That will be an asset that I hold for resale purposes. But do you see how we are thinking about it? That the standards do something or they deal with particular transactions. Wait, no, Funda, what do you mean? Which part is intimidating? Talk to me. Which
Hi,
part?
Rendani. Is my network still fine?
Yes, it's still fine. Yes.
No, it's just all these standards and ISs and all these new things. I'm just like, yo, this is Jurassic Park.
No, so they're gonna mix it. So, and that's why I'm saying we're gonna take it very nice and slowly. We're gonna, by the time you are done, you will navigate this standard so easily. You will navigate, and that's why I package them like this. And when I was saying earlier on, you don't need to do all of them, because if it's an asset, there will be similar requirement. Because if I say whether, let's say I'm buying a car, when I buy a car, I have to pay a price, and that would be the purchase cost. So that would be the cost of the asset. Then you could have bought the same exact car for the same price, and you are going to what? To resell it. You are a dealer. So to you, the car is what? It's inventory. But how do you determine the cost? You determine the cost the same way as me, who is now going to use the car in my own administration. I'm going to be traveling from one client to the other. So when I say that they are grouped together, it helps knowing that, oh, if I know how to account for an asset I buy, then the same principle apply for IS2, IS38, IS40, and so on and so on. So that's why when they are grouped together, it makes it easy to therefore what? Understand. Because it doesn't mean you have to open each and every standard to know how to initially account for it. So it'll get there, I promise. I promise. So those are the accounting what? They are asset standards. And as you can see, they are different based on what they do. IS2, I bought an asset for resale purposes. IS16, I bought an asset to manufacture other assets or to use in my what? Administration. Then IS23, I bought an asset, but I bought it on credit. The IS36, I bought an asset and it's no longer working as I intended to work. Why? Because it was damaged, or because people don't want to buy the goods coming from this asset, or so on and so on. IS38 is because the asset that I've acquired has no tangible form. IS40 is because it's a building that I'm buying for rental to others or for the value to grow. So that's why I call them asset standard. There is an underlying asset. Then now there is what we call the liability standard. In the liability standard, what do we have? We have IS37. What does it do? It tells us, I'm sure you might have been seeing this Vodacom versus, what is his name? But the please call me guy, as they call him. So that is what that is an issue to Vodacom. That's a circumstance or a transaction. So now, if you are now to go find that in Vodacom's financial statements, what does it represent? It represents not an asset to them, but something that could be an obligation for money to be paid to him. All the monies that you are to make to other people, the general principles sit in IS 37. So if we want to then understand how Vodacom it is then treating that issue with the please call me guy, then we will look to IS 37 to see if we agree with them. So Vodacom for the longest time, they've been saying that that is a contingent liability. And a contingent liability, the standard says, is a liability whose existence will be confirmed by a party, by another party, or by circumstances outside the company's control. Or otherwise, it's a liability that we are admitting, but we are unlikely to what? To pay. So think about it when you skip a stop sign, and let's say you stay in Gauteng and you skipped a stop sign back in Limpopo. You might be saying that, yes, I skipped a stop sign, and yes, there was a camera, it took a camera, so I've got a liability. But government, know that I'm not going to put this in my books because I am not going to pay and you are not going to find me. So you could then say that is a what? It's not a liability, it's a continual liability because the likely settlement is almost close to zero. So the standard will say when you've got obligations that are true, but the likely settlement is close to zero, what do you do with them? Or otherwise, when you are being sued by someone and you are waiting for a court outcome to say, no, you are guilty, pay this person. Or, no, you are not guilty, what do you do? The standard will then help us with that. Then contract-based standards. These standards, you can never talk about them unless there is a contract. They don't exist without a contract. There has to be a contract. IFRS 2, IFRS 15, IFRS 16, and IS 32. That's our contract babies. For instance, IFRS 16 is a leasing standard. There has to be a lease agreement between the two parties. IFRS 15 is a revenue standard. There has to be a revenue contract between the two. IFRS 2, it's a share-based payment standard. There is an agreement between the entity and its employees, an agreement between an entity and its executive. That's the standard right there. Then financial instrument, it's what it is. It is a contract-based standard, but I've put it separately because there's what? There are several standards dealing with it, and it's therefore important to group them together. Then group standards, these are the standards that are what? That will help us with preparing group financial accounts. And special standards, these are the standards that cut through regardless of the transaction. So they cut through. So they will apply when it's a group scenario, they will apply when it's a contract-based situation. So they cut through regardless. So for instance, where is IFRS 13? I should include IFRS 13 there. So for instance, when I talk about IS 12, IS 12 is the income tax standard. It is the income tax standard. So later on, when we have done tax, we'll then be talking about what? We will be talking about the tax, deferred tax implication on PPE, deferred tax implication on lease agreements, deferred tax implication on investments. So that is the standard that cuts through. Then the other is IS 21, which is foreign exchange transaction. I can buy an asset on credit or from an overseas supplier. I can sell an asset to an overseas supplier, a customer. I can enter into a transaction to buy a share that is denominated in what? In a currency other than rands. So that will be part of the special standards. So this is the standards that we will then get to master, and we will therefore know for a transaction such as that, where do we need to go? So this is your list of what? Of the standards. So what we've then done is we've taken some of the key standards across. We've taken specific standard across so that we can then discuss, break them down, understand them, and afterwards be able to do what? Be able to then say that, yeah, we are here, we understand them. Okay? Now, when I say a standard, what are you imagining? What does a standard do? Does a standard then tell you all the specific transaction? Is it a list of examples, for instance, that we can refer that example that candidate was talking about and we find it? And the answer to that is that no, a standard is simply a set of principles. It's like a way of doing things. The reason for that is because standards are applied by, because these are international financial reporting standard, meaning that if now you get a job in the UK and they say, oh no, we are using IFRS 16, it will be copy and paste of the standard we are using here. That's why these professions have become what? Have become more global, because we are applying international financial reporting standards. And these standards are therefore structured in a very standard way. So for instance, each and every standard, and I hope you have it, but if you don't, as I'm saying that, I've got the one we're gonna show and go through together to see how it works. So the standard starts off with an objective. Objective just tells us why this standard exists. Where does it come from? Why was it ever created? Why was it necessary? What is it trying to do? That's what the objective is. So when I tell you that I am looking at IS2 and it deals with inventory held for resale, how did I know? The objective told me. So your journey with the standards, first, you just need to be looking at the objective. Okay, let me open IS1. What does this do? Oh, I see. IS2, oh, I see. IS10, oh, I see. So understand what does each and every standard do. So the objective. Then number two, you might find that you have found yourself in the standard and you don't know whether these things, it feels like an overlap. Because now think about what I was just saying before, right? I was saying that there is a standard called IS38, which is an intangible standard. And there is a standard called IFRS 16, which is a contract-based standard. But that agreement for a lease, for the right to use the trademark, I'm getting a right to use an intangible asset, but I have entered into a contract where I get the right to use an asset. So where am I? You wonder. So you are going to look at the scope to see whether the scope does it deal with these things. So the scope will then say, we deal with all agreements except these ones. That's what the scope does. It will help us to know whether we are in or not. So especially early on, don't apply a standard unless you are clear what its scope is. You have to know that the standard deals with these things and it does not deal with those things. right? That's what a scope does. So the scopes will always say, I deal with all assets except. So you know you are excluded, you are excluded, you are excluded. But I love what it does. It will say, I'm excluding you because you are going to be dealt with by the other standard. So for instance, we will then find, yeah, no, you will see it when we get there, yes. But it then tells us what? Don't be here, then go somewhere else because I don't deal with this. That's the scope. Then there will be definitions. So you might be hearing me say it's an intangible asset, it's a financial instrument. But are these my definitions? Is this something that you will need to learn from me? Otherwise, you might not know it. No, the standard tells you and me, or you and I, that what? That a financial instrument is this. An intangible asset is this. This is that. So there are a set of definitions that the standard goes into. Then number 3, it will tell us the initial accounting treatment. So the day we enter into the contract, the standard will tell us what to do. Because back then we were not sure that if we sign an agreement today, what happens? So the standards will tell us that, all right, here we're going to get in when you have done this. And once we have done this, it will tell us what to check. Recognition criteria. It's like that checklist. So think about a recognition criteria to say, what do I need to have, or what needs to be true before I consider this to be an asset or a PPE asset, an IS2. So it just tells me that because it's recognizing that there is a temptation that everybody will go here. So what they then said is that before you recognize this item, make sure it meets the recognition criteria. So these things need to be true before you apply this standard. Then after you agree that these things are true, then let's talk about putting it in the books and ask ourselves at what amount. So the initial measurement, it's when we are saying the first day you put it in your books, it has to be at a particular rand amount. It has to be at a particular currency. Then subsequent treatment. Now that it's in the books, you put it at 100. Is it always going to be at 100 forever? No. When I start using that trademark that I've bought, you will need to have a way to measure it. But the standard says that, but the way to measure something depends. It might depend on the circumstances, how you're using it. It might depend on how you measure it, and so on and so on. So accounting policies are very important when it comes to subsequent measurement, because we're going to hear about revaluation as well as cost model, fair value model, and so on. Then we have how to then remove the item when we are done with it. So I've bought this car and I want to use it for 5 years. 5 years is done. What do I do with it? I have to remove it in my books. But what needs to be true for it to be removed in the books? That's what derecognition helps us to do. Then presentation, I've already mentioned, it tells me that when I put it in the books, which books? Oh, the statement of financial position. So SFP is the statement of financial position. SCF, it is the statement of cash flows. Statement of P&L, statement of profit or loss. Statement of OCI, statement of other comprehensive income. Statement of SCE, statement of changes in equity. So when I talk about, let's understand the difference between the two. So if I say to you, how will this be recognized? I'm saying that how will it enter into the books? So you will need to tell me that this is an asset and it is used for administration purposes. Therefore, it is PPE. When you recognize PPE, you recognize PPE if it is an asset that will be used for more than 12 months. Oh, I'm going to use this for 6 months. That's not PPE. You cannot put it in your books as PPE. All right, can I put it in my books as something else? Yes, probably that's a consumable. But which standard deals with consumables? That's how the thinking works. So recognizing talks about getting it in my books. Then initial measurement talks about what? When it gets into my books, at what amount do I need to put it in? And afterwards, how do I then recognize any benefit I'm receiving as and when I'm driving this car that I've bought? Then now, disclosure. I have recognized things like depreciation, and I have depreciated my vehicles over a 5-year period. Oh, okay. So you have depreciated your vehicles over a 5-year period. Okay, okay. Now, that means we need to recognize the benefit of using the vehicle, and that benefit is called a depreciation. And how do we measure the depreciation is the subsequent measurement. So do you see how we think about this? That when we entered that that trademark agreement, there might be an asset. When we use the trademark, there might be a need to show the benefit of using the license without due consideration to the payment. And we will need to tell our users of the financial statements that, guys, when I use the vehicles I've bought, I expect them to use them for 5 years. Oh, okay, okay. And when I expect them to use them for 5 years, I normally sell them after I've used them for 5 years. Also, they still have value. Yes. And the way that I work is that I then estimate any value that I'm going to get after I've used it at the end of 5 years. So that is how we then think about disclosure. It's just to make the users understand how the numbers they are seeing are derived. That is the point of a disclosure. Does that make sense?
Yes, it does.
Okay.